Well, next up, we go back to US of A. We're going to talk about Kroger, right?
Now, Kroger's my pick for the week, and Kroger it competes with Publix and Winn-Dixie, Piggly Wiggly, okay, but it also competes with Trader Joe's, Aldi, Walmart, and Costco. Even you're looking at 7-Eleven and Target, okay. I didn't realize until today that apparently Walmart is the largest supermarket chain, and Walmart of Mexico is the third largest. So it is fascinating to see. We were talking about Mexico, it's a huge market. And as far as Kroger goes, yeah, they're not heading that way. So we won't worry about them. But if you look at what they are, they're a market cap is somewhere in the region of something that I'm just slipping my mind at the moment.
33 billion.
Market cap's now what, $33.6 billion. Mm-hmm. Their revenues are $45 billion on a running rate. Net income, just under $1 billion. Their EPS at about 1.3 times, and net profit margin is 2%. These guys they're busy, and they're busy out there. Kroger, I have experience with them when I lived in Michigan. They were my go-to supermarket. Now I live in Florida, and they weren't here at all, but they recently started doing home delivery. Yes, and their home delivery is one of their reasons that they're trying to use that to expand in areas that they don't actually have a supermarket. So they're setting up a central hub and then distributing to the likes of you and me who are going to buy online. And there are lots of folks who are investing in them on this basis that they're going to be growing. I mean, they are certainly a growing company. But we're going to go to the downside. When I did use them, not only was half the stuff not available online, when I got my deliveries, half the things that I'd ordered that they had said they had didn't get delivered. So I ended up with a very disappointing result. So their stock has bounced around. It's rising. It's definitely rising, but it's also not a stock that is shooting up. Again, value we're looking at, long term we're looking at, and if they can sort out their, shall we say, teething problems, we'll give them credit for the fact that they've existed for a number of years and they do know what they're doing. I think 1883 was when they were founded, so they really should know what they are doing. And they will no doubt sort out this mismatch of supply and demand and address that. At the risk of turning a few people off on the way, they will sort it out. They will start to grow. If they can do that, they will be really a company that is going to increase its penetration of not only generally into the US market, but specifically into areas like South Florida and other areas where they haven't been in the past. So we can see that there are tremendous opportunities for them. And I know that there have been a number of companies that have taken positions recently on that same basis. They do see this as an opportunity to really see a long-term return. And they're generating $6.2 billion from operations. That's a chunk of change. It really is. And they're growing their cash that they are holding, even after investing in financing. They're growing their cash, which suggests that they're not actually investing everything that they're bringing into this expansion and this growth into a new way of distributing their products. So it looks as if they're underperforming in some ways, despite the overall really positive signs and overperformance relative to the markets in other ways. It looks like they're a hidden gem that really has potential. I mean, we have them rated as a B- at the moment, and partially, I think, because of the way that they've been operating, they've bounced around. They've been bouncing around from a B plus, down to a B, down to a B minus, up to a B, and I think this is partially down to the fact that they are just trying to sort out where their future lies, and that means that you're potentially going to be looking at a really great time to get in for the long term. Again, don't be looking to buy them for tomorrow. You know, it always takes time to grow into another market like this.
Yeah, I'm looking at the ratings page. You've got their risk as a C. What are some of the things that go into that to push it to a C?
That's that'd be volatility, solvency, those kind of the specific to safety type of metrics.
So volatility related just only to price action?
Price action, both absolute and relative. So it looks at a beta to the overall market, but it also looks at its history of returns relative to itself. You know, see it's increasing or decreasing at a higher or lower clip than normal.
Okay. Yeah, and to translate some of that, you know, so what we're assuming there is that, which is, it's not that assuming is bad. It's just maybe the wrong word to use. But what we're using in there is if a stock, its price, you know, if you're looking on the screen here, it's traded between say $42.50 and $47.50, well, $50. If it's trading in a narrow band, and that band is trading in is, let's say, this is we'll just round it up to $8. Round it to $8. So it's in an $8 range, but that range is normally 12 or 13. That's gonna change that volatility skew, right?
That's right, exactly. So yeah, if those bands get wider for the same time frame, then volatility is obviously increased.
Well, volatility can be both good and bad. So so do we compensate that by looking at maybe the sector it's in, or some other comparison? Because obviously if Kroger, let's say it was normally a range of 8 and it goes to 26, that may not be a good thing, right? So, but good thing, you have to ask a good thing relative to what? So what are we using there?
Yeah, so it in terms of like if volatility spikes to 26, it's because it's going to the upside. New CEO, earnings release, or new strategic development. Then that's upside, and that looks volatility, upside volatility in a positive way for ratings. But then it is also the converse, like a drawdown volatility if it's negative news, and that impacts our rating adversely.
Do we ever think, Maceo, the main thing with our ratings is we're looking at safety. So where you might see opportunity, there is also risk. So if you're looking at it from a safety perspective, you're wanting to minimize the risk to take advantage of the upside. So if you've got something that presents a tremendous, you could say in theory, opportunity, and the risk is there as well. I mean, Al will be able to explain to you about risk pricing and where that all balances. In fact, perhaps it's a great opportunity for him. Come on, Al.
Absolutely.
I think, Al, let me jump in before you get started. So what I'm hearing is, just because something is up $26, that may not mean it's a great time to get in.
There's definitely a possibility.
Yeah, okay. Sorry, Al, I jumped all over you. Go ahead.
No worries. But to your point, early when I started, I used to have that kind of bias. Oh, the stock is up a lot. I'm not going to touch it. Let's wait. And the portfolio manager I work with pulled the chart for a specific period and say, okay. And obviously the chart goes with a major spike in price and say, okay, what you like here, what you're saying, no, do you want to wait because it's up? it was something like 60%. It was a crazy number. Then he moved the chart a little bit, and the stock was up again another 30%. So, oh my God, so it's scary. So you don't want to buy it. Then he moves it a little bit, it slides up, and then it goes up another 30%. So just like when things go down and they say you don't want to catch a falling knife, things on the upside also sometimes you don't want to lose the momentum. On top of that, again, my personal bias is more of a value rather than just momentum and growth. And this is why we usually look at things in what we call it GAR, growth at a reasonable price. So I think Kroger touched base on both sides. You get a very reasonable valuation again, and so you get both sides. As I've said, you get the reasonable valuation and you get the potential of growth with their new initiative, delivery at home. That will make them a more asset-light balance sheet. You don't have to go and establish, lease, or build new grocery stores while you can just, in the areas that you don't serve, you deliver there. And a lot of people are moving towards that, especially, again, Corona has made a kind of paradigm shift in so many businesses, including the grocery and the deliveries. So I think you get, again, the good side of both worlds. You get the valuation and you get the potential growth that's going to come from the new strategy they follow. And you have, potential momentum in the stock. I'm not the momentum person. Maybe you guys be way better than me to establish when you look at the chart. But yeah, that element might be there.
Well, I know we're talking about value here. So, these are typically going to be the companies that are plodding along, compared to an NVIDIA or some of the stuff that we talked about the last time, for sure. But what are some of the ways, if a person was going to go into the Weiss Ratings website, what areas would they be focused on, Al, to maybe think about how to tell if it's too much, right? Because you can always ask how high is too high. That was, I think, the example you gave. But are there some ways that they might be able to look at maybe some of the key statistics or other areas on the site where they could determine?
Absolutely. I think the compare tab, when you put it versus sector, and Mandeep can, elaborate on that. Also, when we look at that tab, because we know there's a difference between the price and the value. We can't say a price is expensive just because the stock price is at $1,000, right? It could be a $10 stock price, but it's so expensive, more than $1,000 a stock, because we're going to look at the multiples. And I think here where it tells you that, if you look at their earning per share growth, is much higher than the sector. While when you look at their price earnings, it's almost in line with the sector. So when you look at the adjusted PEC price earning to growth, it's much lower than the sector. And this is why no matter how much this stock ran, is still, from a valuation point of view, it looks so cheap. Look at their price to sales. It's still cheap. So in general, these guys, given the growth they're offering recently, their valuation is cheaper than the sector. We call it unwarranted discount to the sector given their growth. The market might be a little bit skeptical about the sustainability of their growth. And the more the company proves that they are able to maintain such a strong growth and continue to grow, the market will start to adjust their thinking about this stock, and maybe will start to pick on that stock, and then you can see more inflows and more volumes in the trading of the stock.
Mm-hmm. Well, now we're really striking to the heart of investing, right? So this would be where, say, somebody invests in a stock like Kroger. One of the things that they should keep up with, or ideally even ask their advisor, the last time we talked about having a fee-based advisor, it would be to task that advisor with getting that information. Hey, you need to find out how these people are performing. How is management performing? If they do have some false starts with their delivery, who are they hiring to fix that? Obviously they've got to delegate. It's not like the CEO's going down and picking stuff off the shelves. So are they making the correct hires? And if they are making the correct hires, why do we think it's a correct hire? But yeah, I'm looking at this and man, no wonder you picked it. These numbers are absolutely fantastic. Especially relative to the sector. Wow.
Well, the thing certainly with Kroger is this is based on their missteps, I'm going to call them.
Right.
So if they get it right, they've got tremendous potential. So you look at it as it is, and you'll say, okay, this is a good or reasonable opportunity for a good investment. Yeah. And if they get it right, well, you could do really nicely out of this and reap the rewards. They also do pay a dividend, so it's not as if you'll be left sitting there without anything coming in. They're paying you a dividend as well.